The current live price for SOFI Technologies Inc. is $19.72, marking an intraday increase of 1.49% as of 5:15 a.m. ET on April 21, 2026. While the broader market might view this as just another green morning for a fintech favorite, the reality beneath the surface suggests we are seeing the first signs of a major structural shift in how institutions are valuing this company. Most retail investors on the Fidelity mobile app or checking their Robinhood stock trading accounts see SOFI as a high-beta growth play that follows the NASDAQ. However, the expectation that SOFI is merely a digital lender is being shattered by a reality where its financial services and technology platform are now the primary engines of its valuation. We aren't just looking at a bank, we are looking at the potential AWS of fintech finally reaching a critical mass that the market has ignored for 3 years. The common ground among investors right now is a sense of cautious optimism. After the volatility of the past year, many people using SOFI Invest or various investing sites have been waiting for the stock to break out of its long-term range. The general belief is that high interest rates are the only thing holding SOFI back, but I want to challenge that narrative. The deeper reality is that SOFI has spent the last 12 months decoupling its success from the interest rate cycle. While traditional banks are struggling with shrinking net interest margins, SOFI is reporting record fee-based revenue, which surged over 50% year over year in the most recent periods. This is the contrarian take you need to consider. The market is pricing SOFI like a bank that needs low rates to survive, but the internal numbers show a technology company that is thriving because it owns the entire stack, from the national bank charter down to the Galileo processing core. Looking at the immediate price action, today's volume is showing a distinct lean towards institutional accumulation. We've seen significant blocks of shares moving in a way that suggests large funds are repositioning ahead of the next major catalyst. This isn't the typical meme stock retail frenzy we saw in years past. Instead, it's a calculated move into a company that just hit a Rule of 40 score of 68%. For those who track technicals on their Fidelity trading platform, the stock is currently testing a key resistance level that has held firm since late 2025. If it breaks and holds above $20 with sustained volume, we could see a rapid re-rating. Macroeconomic pressures remain, specifically the lingering concerns about credit quality in the personal loan space, but SOFI's net charge-off rates have actually been trending downward, defying the bearish expectations that consumers would buckle under inflation. This tension between what the market expects and what the company delivers is where the real opportunity lies for those involved in online investing. If you look at the Robinhood app, you'll see a lot of chatter about student loans and personal debt, but the real story is the SOFI bank charter. By bringing deposits in-house, they've lowered their cost of funds to a level the competitors like Upstart or even some legacy institutions can't match. This allows them to offer competitive rates on the SOFI mobile app while maintaining margins that make the individual brokerage side of their business look like a secondary benefit rather than a primary risk. We are seeing a massive transition where the lending company is becoming a wealth company. Comment below how many shares of SOFI stock you currently hold and what your average cost basis is. I'm curious to see how many of you have been building a position during this multi-year consolidation phase. The recent movement in SOFI stock has been heavily influenced by the expansion of its loan platform business. In late March, the company locked in over $3.6 billion in new personal loan delivery commitments. This is a massive development because it proves that institutional buyers still have a high appetite for SOFI's credit underwriting. While critics on some investing sites pointed to a controversial short report earlier this year alleging accounting discrepancies, the reality is that major analysts, including those from JP Morgan, have since upgraded the stock to overweight, effectively dismissing those claims as a misunderstanding of how bank accounting works for a nationally chartered institution. This disconnect, where a loud minority screams risk while the quiet minority of institutional capital builds a buy thesis, is exactly the kind of setup that leads to explosive moves once the narrative settles. To understand where we are going, we have to look at what SOFI actually is today. It's a three-headed monster: lending, financial services, and the technology platform. The lending side, which covers student loans, mortgages, and personal loans, is now effectively a cash flow machine that funds the growth of the other two. The financial services segment, which includes SOFI Invest, credit cards, and the Robinhood-style crypto offerings, is finally profitable on a contribution basis. Then you have the technology platform, powered by Galileo and Technisys, which acts as the infrastructure for other companies to launch their own financial products. This is why people compare it to Amazon. They are building the infrastructure that their competitors will eventually have to pay to use. The business model is built on vertical integration. By owning the bank, the tech, and the user-facing app, they capture the margin at every single step of the process. This is a far cry from the early days of social finance, which was just a student loan refinancing shop. If you're using an interactive brokers platform or Schwab Intelligent Portfolios, you're seeing the industry from the perspective of established giants. SOFI is the first digital native firm to successfully navigate the transition from a growth-at-all-costs startup to a profitable at-scale bank. Their recent launch of big business banking shows they are no longer content just serving the individual. They are moving into the enterprise space, competing directly with Chase and Bank of America. When we talk about the future outlook, we have to frame it through the lens of expectations versus reality once again. Wall Street expects 2026 to be a year of steady, moderate growth. However, management has issued guidance for roughly 30% revenue growth and an even more aggressive expansion of adjusted EBITDA. If they hit those numbers, the current valuation will look incredibly cheap in hindsight. The catalyst to watch over the next quarter is the performance of the SOFI USD stablecoin and their blockchain-powered international remittances. By moving money on-chain, they are cutting out the middleman fees that have traditionally padded the pockets of old-school banks. This is a direct threat to the status quo, and it's why the stock often faces such intense scrutiny from legacy financial analysts. There are risks, of course. A significant downturn in the labor market could lead to a spike in defaults, which would hurt any company with a large loan book. Furthermore, the regulatory environment for crypto and fintech remains a moving target. But SOFI has positioned itself as the adult in the room by becoming a nationally chartered bank. They play by the same rules as the big guys, which gives them a level of stability that platforms like Robinhood or SOFI's smaller fintech peers sometimes lack. When you compare SOFI stock to something like Nvidia stock or Apple stock, the volatility is higher, but the potential for a fundamental re-rating is arguably much greater because the market still hasn't decided if it's a bank or a technology company. The reality of the situation is that SOFI is currently in a prove-it phase. The numbers are there, record revenue, record members, and consistent profitability, but the market sentiment is lagging. This gap is where smart investors often find their edge. Whether you are doing self-investing through a Fidelity brokerage account or using a SOFI robo-advisor, the underlying thesis remains the same. The company is outperforming its stock price. As we move further into 2026, the noise from the short sellers and the macro doom posters will likely fade, replaced by the cold, hard reality of quarterly earnings beats and expanding margins. In summary, we started the day at $19.72 with a bullish tilt, but the real story isn't the 1.5% gain. It's the fact that SOFI has successfully navigated the most difficult interest rate environment in decades and came out the other side more profitable than ever. The expectation was that they would fail or be forced to raise capital. The reality is that they have over $1 billion in quarterly revenue and a member base that is growing by 1 million people every few months. This contrast is the foundation of a high-conviction investment case. As the market begins to recognize the technology platform's value and the bank's stability, the tension between the fintech label and the bank reality will resolve in favor of those who understood the business model early. Stay focused on the data, watch the institutional flow, and don't let the short-term swings on your Fidelity mobile app distract you from the long-term trajectory. SOFI Technologies is no longer a speculative play. It is a fundamental pillar of the new financial landscape. The authority they have built through their bank charter and technological infrastructure makes them a formidable player that is only just beginning to flex its true muscle. We've seen the expectations fall short of the reality time and time again, and as long as that gap exists, the opportunity for growth remains. Keep a close eye on the upcoming earnings report to see if the credit quality continues to hold firm. That will be the final piece of the puzzle that forces the bears to finally cover their positions and lets the stock reach its true potential. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.